ladies and gentlemen. A very warm welcome to you on Business Today Television on our ongoing series of Diwali Specials, the Market Guru segment. We bring to you brains on the Lal Street who navigate bull and bear markets with equal ease. They are home with volatility and have made supernormal returns for their shareholders. Our guest today, ladies and gentlemen, is Mr. Aashish Somaiyaa, a veteran of Dalal Street. He's the CEO of WhiteOak Capital Asset Management Company. Mr. Somaiyaa manages about 36,000 crore rupees in domestic equities via mutual funds and PMS, and of course above 55,000 crore rupees in global funds. Namaste Aashish ji, a very warm welcome to you. And Diwali is turning out to be good for the markets. We've been running up quite sharply after almost 10, 11 months, 12 months, 13 months of flat returns. How are you watching sentiment at this point of time when monthly SIPs in mutual funds have hit a record high of 29,000 crore rupees each month?
Yes, so I think, a lot of people have been, general commentary in the past, has been that if the market doesn't do too much or if people don't make returns, then the interest levels on the SIPs and all will start dwindling and, SIPs will stop, or that a lot of people who have entered after 2020, they may feel discouraged from continuing investing, etc. Thankfully, a lot of those fears haven't really played out. And in my experience, I have seen that at any point in time in the markets, there are always different cohorts of people. Like some people who have seen a couple of market cycles, some people who have seen only one market cycle, some who have entered only on the upside, or some who have only seen downside. There are all cohorts of people at different points in time. But I think now one thing I can say is that there is a critical mass of people, critical mass of investors who have seen it all and who understand that this is how it works, because now the market itself has a long history, regulation, technology, knowledge levels of people, education, the history that they have seen of the market. I think a lot of things have evolved over a period of time, and we definitely have a critical mass of investors who will, I think, stick with the market through thick and thin. And that is what we are now witnessing.
Okay. Ladies and gentlemen, that's a broad understanding that many fund managers and peers of Mr. Somaiyaa have shared with us, that there is a rising tide of intelligent people who are averaging the market both up and down via monthly SIPs, and they really don't care where the market is as long as fund managers such as Mr. Somaiyaa deploy those assets sensibly, and they do. The entire performance sheet of WhiteOak Capital is in front of me. If you look at the 1 year rankings, many of their funds are in upper quartile. You look at WhiteOak Capital Multi-Asset Allocation Fund, it's first amongst 34 peers. Look at how strongly the performance is in Capital Arbitrage Fund, first amongst 28 funds over a 12-month period. Balanced Advantage is doing phenomenally well, second over the last 12 months in 37 funds, and of course Pharma and Healthcare first position in 1 year, WhiteOak Balanced Hybrid first, and the list goes on. The best one, ladies and gentlemen, is WhiteOak Midcap Fund. Just 2.5, 3 years in existence, and out of 46 funds, it's ranked second. So, Mr. Somaiyaa, firstly, congratulations for this wonderful performance over the last 12 months at a time when the market has not given anything at all. Now, what were the 2 or 3 reasons why these performance was so strong, and how do you see the next 12 months from the point of view of a fund manager trying to navigate the Lal Street?
Sure. Thank you for reading the data and acknowledging it. Thank you very much for that. Now, see, there are 2 or 3 reasons why the things have thankfully played out the way they have. And I think I'm proud of the team, and, more acknowledgement is coming our way precisely because of what you said. That, see, 2023 and 2024, the markets were rewarding heavily. Thankfully, we are being recognized because in the last 1 year, the index has not given any return, but some of these funds have done well. There are 2 reasons for this. First reason, if you really ask me, Shailender, is that in our industry and in our market, there is a lot of enthusiastic reception for stock picking. So people generally feel, a lot of our audience also might feel that fund management is all about stock picking. And yes, stock picking is important. We ourselves have 35 analysts covering 1,000 companies, and everybody would, narrate success stories about which stocks people have picked. So there is a huge fascination that fund management is about buying the right stocks, and I don't take anything away from that. But equally important is that as professional managers, when we are managing money to beat a benchmark, like BSE 500, or like say a multi-asset benchmark or a mid-cap benchmark, when you are managing a portfolio to beat the benchmark, stock picking is important, but then equally important is your portfolio construction. In years like 23, 24, what happens is that the benchmark or any portfolio, there is a lopsided impact of whether you own PSU or not, whether you own railway, defense and infrastructure, or you own good quality free cash flow, whether you own PSU or you own private. So years like 23, 24, the market was lopsided, that few things were working very sharply and few things were not working. So this is what I would call, like a market which has certain trends or certain sectors or factors which are driving the performance, and a diversified portfolio which is doing bottom-up stock picking was suffering. This was till mid-24. But after 24 onwards, what has happened? The market is going nowhere. There is no sector, no factor, no trend, or no specific part of the market which is driving it. In these times, somebody like us who has not lost track of the broad market, who has stuck to principles that, okay, we are running this portfolio to beat the benchmark consistently over a period of time. We don't carry it away that just because PSU, defense, railway, infra is going up, or just because small cap is going up, we don't allow our portfolio to get enamored by those short-term trends. We don't allow our portfolio to get distracted from the market averages. So we stick to our principles that, okay, this is the portfolio, this is the benchmark. We have to ensure that the portfolio represents the market, and on a relative basis, it's the stock picking which generates the outperformance. So last 1 year, ensuring that we don't lose our tethering and we don't stray from the principles during bullish markets has helped that we preserve the performance when the tide actually turned. So this is one thing which has helped. Second, you were kind enough to read about, say, pharma fund or multi-asset, for instance. That happens because of a slightly a contrarian kind of approach. We launched pharma fund in 2024, whereas everybody was that time chasing, what I said, defense, railway, infra, PSU, etc. We launched a fund with 25% allocation to gold in 2023. So now it is showing up on the top because last 2 years we were consistently allocating to gold and precious metals. So I think two reasons. One is not losing sight of sound portfolio construction in bullish times, which helps you preserve performance in bearish times. And second is being slightly counter-cyclical and not getting carried away with the momentum. I think both these things have helped.
Wonderful. And full marks to your fund managers and your team if you allocated 25% to gold in the WhiteOak Capital Multi-Asset Allocation Fund. The NAV is 15.34, and this one started in May of 2023. Okay. At this point of time, Aashish ji, what do you think of precious metals? You brought a point that right on in early part, 25% of the multi-allocation fund was into commodities. At this point of time, I see it is at 10%. So you're trimming and booking these gains, and where is that money going in?
Yes, absolutely. You read it bang on. So our exposure to gold was about 23-24% in April, May, June of 2024. And now, of course, we are at the bottom end. In fact, the floor level is 10%. We are near the floor level. So that change is happening because, in these multi-asset allocation funds, what we do is we are following relative valuation models. So we have to take decisions that how much of equity to own, how much of gold to own. So, for equity, we will see what is the adjusted price to book, like what is the current price to book of the market adjusted for the level of ROE that is available in the market versus how the trend has moved in the last 10 years. So if you go by average price to book and keep the ROEs in mind, equity has become a bit attractive compared to what it was 1 year back. Second, interest rates have gone down. So the yield ratio has moved in favor of equity. So because of these two things, 1 year point to point, equity allocation has gone up a little bit. Like last year when gold was 23-24%, equity was also more like 24-25%. Now gold has consistently been traveling downwards in terms of allocation. Equity in April we went all the way to April 25 we went to 33 or 34% equity. Now again equity has been trimmed to about 28 or 29%, maybe 30%. So a little bit allocation has gone to equity. We have increased, after SEBI changed the norms, we have increased allocation, started increasing allocation to REITs and InvITs because we find that that is a good fix in a hybrid product like multi-asset. And then of course fixed income also has gone up. So gold has gone down, REIT, InvIT, equity and fixed income, those allocations have actually gone up. I do feel on your question on precious metals, if I leave aside multi-asset and our relative valuation models, I personally do feel that till the time people have concern on US equity markets and US economy and this tariff and geopolitics, till the time people are focused on that, from time to time you will see that gold and silver, it's in the news. It will continue to hog the limelights. Sometimes 5% up, sometimes 5% down, that may happen, but it will be in the news till the time the global macro is the way it is.
Right. Ashish ji, देखिए, it can be in news and it can be in demand, but end of the day what matters is कि पैसे किसने बनाए, कब बनाए और कैसे बनाए. अब वहाँ पर डेटा ही दिखा रहा है कि आपको महारत इसमें हासिल है और आप इस वक्त गोल्ड और सिल्वर को ट्रिम कर रहे हैं, जो कि प्रैक्टिकली एक बहुत ही अच्छी बात है. मतलब जब ये मेरा अपना एक इंटरनल पैरामीटर है, जो भूला बिसरा 2 साल 3 साल 5 साल में पहली बार फ़ोन करे और पूछे भाई गोल्ड ले लूँ क्या या सिल्वर ले लूँ क्या, तो समझिए कि टॉप आ चुका. अब वो टॉप किस समय आएगा ये पता नहीं, लेकिन टॉप आ चुका. बहरहाल, लेट्स लुक एट योर वंडरफुल फंड विच इज़ अगेन द मिड कैप fund, 2.5 years of launch, and it's doing excellently well as far as the performance is concerned. What were the 2 or 3 great trades that worked in your favor as far as the WhiteOak Midcap fund is concerned? Strong returns there as well.
So Shailji, actually again here, there is 2 or 3 things to keep in mind. First is, and thankfully this fund just finished 3 years now. It was launched in August 2022, September 2022. Just last month it has completed 3 years of track record. So, one is that there is a very, very large, at WhiteOak, probably amongst the largest research teams. So the coverage, for every sector, depending on size of sector, there are at least 5 to 7 analysts. So if I take example of BFSI, there will be probably totally 9 people covering BFSI. If I take pharma, chemicals, healthcare, it will be about totally 7 people in the organization covering. So first thing is that literally we invest across the market. We are not preoccupied with any favorite sector or any top-down preference. We always keep in mind what is the, like if mid-cap, BSE mid-cap 150 total return index is our benchmark, then what we will do is we'll create a portfolio which is related to the benchmark and not allow any recent trends or biases to make our portfolio drift in any one direction. We are very mindful what is the composition of the benchmark and what we need to do to have consistent outperformance. See, if we produce a lot of outperformance by being heavily overweight on some sectors and heavily underweight on some sectors, by being overweight on some style like growth, value, and underweight on some style, right? So when people produce a lot of alpha by betting on style or sector, when they get alpha, they get a huge alpha. But when the macro environment changes, when the market rotates, growth ka value, value ka growth, PSU private, private PSU, defensive cyclical, domestic export, all these things keep rotating depending on macro environment. What we do is we don't allow the portfolio to get tilted in any direction. And irrespective of macro environment, we make sure that our portfolio is balanced and broad-based versus the benchmark composition. So that lends stability and consistency to performance. And the second thing is that, of course, like I said, there are 35 analysts. In every sector, we are trying to pick relative winners. So what happens is that if you take 2024, the predominant sentiment was that IT is, gone case. Nothing is going to happen. But if you look closely, in 2024, small and mid-cap IT companies or IT companies which were serving Indian BFSI, they did very, very well, whereas the headline on IT was bad. Then if you see in 2024, the PSUs and some other stuff was hogging the limelight, but the best performing sector was actually healthcare for 2024. So when you run a balanced portfolio and in every sector you look for relative winners, it ensures that you don't miss out what is not being attended by the market. So that has been the portfolio construction and stock picking. Both have actually contributed.
Okay, when we look at the mid-cap fund at WhiteOak Capital, ladies and gentlemen, 127 stocks, and out of 127 stocks, there is very, very little, as Mr. Somaiyaa was pointing out, divergence from what the underlying index is. So the top pick is Muthoot Finance. Well, it's been a great ride for this stock over the last 6 months or so. It's just 3.5% of assets, followed by Max Financial. Bharti Hexacom has hit repeated highs, and so has Fortis Healthcare, Persistent Limited and Phoenix Limited. So these are stocks that we repeatedly see coming into record highs, in particular Fortis, Persistent, Hexacom and Muthoot Finance. And these are 4 out of top 5 stocks held by the mid-cap fund. Aashish ji, you very well explained that your job is to beat the index and not be into a concentrated region, a concentrated sector. Now, what ahead? The monthly SIPs that are coming into WhiteOak Capital, in particular mid-cap and small cap, how are you allocating them? Are you sticking to your knitting or are you looking out?
So, just like thanks for reading out the top names, you must have noticed, like I was telling in my description, that intuitively the headline is not with IT or healthcare. But out of 5, you can see 3 to 4 stocks are IT and healthcare. Yes. Because we are respectful of the lay of the land. Correct. We are respectful that which benchmark we are fighting a battle with, and we are mindful that how to pick relative winners. So that is the point. Second thing is that there is large number of stocks that is also deliberate. We have large number of analysts covering large number of stocks. So I don't want to give an impression that this is like a spray and pray or a over diversified strategy. That's not the point. The point is that in recent times, even the regulator has made it mandatory for mutual funds to disclose information ratio. Now, this information ratio is a great measure, not just of alpha. It is alpha divided by variability or standard deviation of alpha. So, generating alpha requires active management in a portfolio. But I can have active management, let's say I can have 60-70% portfolio active versus benchmark. If I do 60-70% active with 20 stocks, it will give me a particular result. If I do 60-70% active with 120 stocks, it will give a different result. But what's the difference? When you have highly active portfolio with 20 stocks, your alpha will have wild swings. Sometimes you get plus 20 alpha, sometimes you will get minus 20 alpha. But when you have 60-70% active weight with 127 stocks which are well researched, you will get more consistent alpha. You will not have wild swings. So this entire effort is to deliver consistency and not just highest performance. In terms of way forward also, we will stick to our knitting because we want consistency. What I've learned is that beating the benchmark, delivering good performance, all of these are about optimizing. If you try to maximize, somewhere Mr. Market will turn around and minimize you. But if you want to be consistent, you have to optimize. And that is what the whole strategy is going to be. So, when we get inflows, we stick to the knitting. I mean, we would like to allocate within that basket. Of course, some underweights and overweights, we might tweak. Something has run up a lot, we might buy less of that. That weightages will adjust, but basically we'll stick to the strategy.
Fair point. And if it has worked in the past, it should work very well in the future as well. As they say in markets, you should do the least amount of effort to change something that is outperforming and let the good run continue. You look at the broader trajectory as far as tailwinds are concerned on the Lal Street, Aashish ji. Lots of good news in the last 8 months or so. We've had income tax cuts, you have GST cuts, you've had interest rate cuts, and of course a good monsoon. Broadly, is it an easier life for fund managers now to pick stocks, given that tailwinds are in your favor?
Yes, see, I think what is happening is that ultimately the performance is beta plus alpha. In last 1 year, the beta, which is the index return, in last 1 year, the beta, which is the index return, has been practically zero. And the reality is that, when the index return is zero, we generate 4-5% return. But all said and done, our relative performance is good. But if I look at it from a client's perspective, well, yes, all said and done, the client has got, say, 4-5% return because that's only the alpha. The index return is not there. So in any active management product, the return is beta plus alpha. And I think that the operating environment, this wide dispersion, it's a great time for us. Because if the market is not becoming lopsided with any particular sector or any particular style or factor, that means bottom-up stock picking will work, and we are very enthused. It's very good for us. As far as clients are concerned, I think you are right that the total return, there is a contribution of the index return in the total return. Alpha is just one part of it. And I think from here on, the index return is set to improve, I personally feel, because like you rightly said, a lot of things in the domestic environment are improving. Out of all of the things you said, one thing which I'm most hopeful about is that the RBI seems to be indicating a risk-on kind of mode. Otherwise, Shailji, you don't see RBI trying to relax capital provisioning norms, relaxing ECB-related borrowing norms, right? Making it easier for companies to borrow and making it almost pushing banks to start lending. So, last 2012 to 2020 was such that everybody went into a shell. A lot of businessmen lost companies to IBC and NCLT. The government got a fragile 5 kind of rating. Banks had 10 lakh crores worth of NPA. I think we are probably, early hints are that we are coming out of that shell and trying to grow the, credit and grow the business. So I am a bit, looking forward to hearing more on that. Plus, the government has also, opened up the, taxation and the fiscal policy. So, quite hopeful that this trajectory continues. We will have an overhang, because US now people were first saying AI is a hype. Now, slowly, the word bubble is also entering the lexicon. So, a US economy, the US markets, possibility of a correction. I think from time to time that will cause turbulence. But since our domestic conditions are improving, I think there is limited downside and maybe a lot to look forward to.
Okay, downside is limited, and because there's a lot to look forward to, why don't you make a guesstimate of where the Nifty should be 1 year from now? It will definitely help our viewers to, maybe either increase SIPs or add to existing ones.
So the good news, Shailji, is that, last 1 year, because the index didn't move, the beauty about the stock market is that if 1 year the index doesn't move, then automatically it becomes 10-12% cheaper compared to what it used to be. So that starts adding to the comfort and the downside protection. That is one. Now coming to the straightforward question, I would say low double digit is a good guess. I would say that if we meet again next Diwali, we'll be higher than where we are. And I would say low double digit is a good guess. I hope the nominal GDP growth from here improves. And I think low double digit is a good guess to keep in mind.
Fair point. So low double digit would be about 5% higher from now on?
Yeah, so I would say that, anywhere in the vicinity of 11-12% kind of growth. Because see, FY27 earnings growth is also being projected at low double digit kind of number. And I think nominal GDP we are at 9%. I hope that there is some improvement there. So I would be happy if the index appreciates anywhere in the vicinity of 12%, I'll be happy with it.
Wonderful. Let's take that and stick to it. Aashish ji, of the 29,000 crores that is coming into monthly SIPs, how much is WhiteOak's percentage share?
So we are, very young company, Shailji, but I can tell you approximately we get systematic transactions worth about 465 crores a month.
Okay, तो आप समझिए कि
1.5 से 2.5%.
465 a month, roughly 450, let's just say Okay, and which is the fund that is attracting the highest monthly SIP at WhiteOak Capital?
It will be our mid-cap fund, Shailendra. So mid-cap, flexi-cap, and then multi-cap in that order.
है ना? Correct. Okay, and all three, ladies and gentlemen, are either 1 or 2 on the 1-year return of charts, and that is where the bulk of money is coming in. Aashish ji, time is of the essence, and of course, you are a very busy man as far as markets are concerned. Any sectors that you are not touching at the moment?
No, Shailji. So that we are never, there is nothing called no. Like I said, there is, we are very respectful about it's not about my investment team or analysts' personal preference. The point is that we are here to beat the benchmark. And hence, and we don't want to beat the benchmark by saying this will work, that will not work. We are here to deliver relative performance. So even if everybody is a pygmy, I will look for a tall pygmy. Even when nobody wanted to buy IT, we had some 7-8% exposure to IT, and we said, okay, forget what the market is saying. On a bottom-up basis, which are the relative winners? So there is nothing which is a strict no. We will always look for relative winners so that we can have consistent outperformance.
Right. On this wonderful note, Aashish ji, thank you so much for your time. Wonderful explanations as to how WhiteOak Capital and AMC work towards choosing stocks to be a part of their long-term portfolios. Here's wishing everybody in your team, sales, marketing, analysts, fund managers, you, their families, a great year ahead, a very happy Diwali, and all the good luck to you.
Thank you, Shailji. Wish you a very happy Diwali in advance. Thank you.
That, ladies and gentlemen, was Mr. Aashish Somaiyaa, CEO of WhiteOak Capital. The gentleman runs about 36,000 crores in India and manages a basket of about 54,000 crores in global funds. WhiteOak Capital is a new AMC, but many of their funds are in the upper quartile, if not at first, second and third rank over the last 1 year or so. The quality of stock picking, as also the logic of sticking to the needing and trying to beat the index to which they are based on, is one of the few AMCs that has done consistently well over different asset classes and in different time frames. Thank you for watching. I hope you enjoyed the show as much as our team did in putting this up. Please stay tuned to Business Today Television. There's a lot that's happening on the other side of the break. Thank you.